Okay, while we are setting this one up, good to see so many of you on a Saturday afternoon. If I'm not here, I'll be sleeping at home because it's so damn hot outside there. I see a few familiar faces as well. I've been talking every Saturday for this month, a bit loser. Even Hari Raya weekend, I have to chokang. For those of you who are still here from previous session, actually Uncle here, nothing new to add to the depressing outlook that we've said before. So we'll get more depressed as we go along. We know whose fault it is. It's certainly not our fault. So we see what those Ang Mo will have to say and do over the next few days. That's basically it, what we're saying. But I still need to fill half an hour and entertain you lot. And otherwise, David here will get a big rotang and chase after me. Okay, outlook. Well, it's a bit, blur at the moment, to say the least. So, in essence, for those who haven't seen this before, and for those who have, I certainly see a few friends here. This is a good time to relax, to rest. And then you wake up for all the exciting bits at the end of what to buy, and not from me, I have nothing to sell. That comes later on as well. So, essentially, we know where the problem and issue is. It's really still about, Europe. It's still about US and what they intend to do about saving their own backside. Their easiest solution here is pass the hat around. Here, I need more money, please, and help us, and we'll help you as well. But we all say we're not that stupid. So that lies the problem. Same with the German as well. So we'll go through a few key things. For those of you who haven't seen some of the slides before, I would just want to leave you with some of the key, perhaps, indicators that can help you make up your investment decision before. For some of you who have seen them before, I'll just update what were the data points that we last discussed over the last few weekends. So essentially, it will be the Europe side, the US side, here in China, hard landing, soft landing, semi-other landing, and then we'll see what it means for us all. Basically, just keeping finger crossed, in that sense. Okay. So far, I think from what we see around us, the easiest indication for us is what we see happening on the ground itself. And among the things that I monitor is how busy the airport, how busy, whether tourists are coming or traveling around. And certainly from there, this is kind of like the summary of the chart itself. Plenty of people going around. And I think the Nantas Fair is coming up. And I certainly expect lots of you guys who are not here to be there queuing up for the best deal as well. So Hangzheng Boho, but still can go and eat kimchi and so that's good in a sense. It certainly shows confidence in the economy here. Two things. One is that there's job security and there's still job creation as well, which is why you're confident enough to at least say, okay lah, let's take a little bit of a break itself. I certainly expect many to sign up for European holiday because it's so dirt cheap at this moment, but just be wary for Christmas. Those Italians could suka go on strike and you might be stranded at Siena for a little while, but at least better to be stranded eating pasta, well assuming that they still make those stuff over there. So this is the kind of environment that we have at this point here. And then certainly here, while things are slowing down, because the demand from the European side, the developed economy has slowed down a little bit, what we are still seeing here is people are still generally gainfully employed. Two sides. One is you have a very accommodative still monetary policy, government keeping interest rate relatively low, and government also spending to keep the domestic side going as well, just as we're seeing, not just in Singapore, but in Malaysia, Indonesia, the Philippines, Thailand as well. So the growth environment, though softer than, say, the last couple of years, is still better than the rest of the world itself. And this is seen in terms of all these numbers that we've got. Right. And actually, which is why, if you look at how busy the ports are, they're not that quiet, Every time I go past the Tanjong Pagar ports itself, those boxes are still stacked up there. And so if you look at US traffic itself, at the bottom there, it is still holding steady to some extent. The hard part from us here is that we don't know how many of those boxes stacked up are empties or are filled up. So those stacks, we can't tell. The Europeans, the US one, they do publish empties. Long time ago, before the Asian financial crisis, for those uppaid like me, they do publish empties. But after that, they say, you don't need to know lah. So we just need to see boxes up there. So from the US side, the empties are still actually surprisingly stable, not that great in terms of empty boxes. So it still looks at this point, if there's one silver lining here, that the US side, it's not doing as badly, although Bernanke says things are quieter at this point, which is true in that the job creation, etc., is still rather sluggish at this point. But we'll go through them in a little while. Right, but the key thing for us still is about confidence. And confidence at this point is lacking, and which is why all the numbers that we are all tracking very keenly is order flows. This is now end of August, we better pray to the ghosts to be more busy and consume a lot more this time around, because the real people in the world, in the West, they are not consuming as much. So what we are seeing really is because of the lack of confidence, the order flows have slowed down. And this is the numbers that everyone is tracking now. And now is a good time. We've got over the last couple of days, the European PMI numbers, basically just a measure of activities at the factory level, whether they're receiving orders, whether they're producing the cheese and whatnot for the year-end Christmas period, or whether they're hiring people, etc. So some numbers are the so-called the PMI numbers, the Purchasing Manager Indices itself. And we are seeing the August numbers starting to stream in now. We've got the European one, still minus 50, meaning a little slight contraction, but not severely so, which is good. Here in Asia, we've seen a couple of flash estimates for China one. This one bounces around, which is why the market was a little bit nervous on both Thursday and Friday, because the two numbers that came out, the HSBC PMI, the red line, the last two lines, as you can see, dipped, and the MNI business survey dipped. They capture different segments. The HSBC one capture essentially the smaller SMEs business in China. The MNI one are the large SOE firms. So what they both shows is that whether SME or the export-oriented SOE order flows have slowed down, not just from the previous month, but into August as well, which basically means that for this period, it's not so good, because they should be busy making their fake Rolex watches, fake Christmas tree, big or small one, fake angels, fake Star David, all these things should be coming through by now. But perhaps of the uncertainty, they have held back to some extent. But what it does show now is that for China, activities have slowed down. And the question is, the key numbers that will come out on the 1st of September, another weekend burn for me, because that's a Saturday. The Chinese just suka release on a fixed day, whether it's Saturday, Sunday, or Monday. So on the 1st of September, they're going to release the national so-called PMI numbers. So far, since they first started compiling that PMI series, for every August, it has never, ever declined. It's always held at or above 50, except for 1 year, 2008. Even then, for that month, between July and August, it was unchanged from the previous month. So we could potentially, which is why I'm keeping my fingers and my toes closed as to what the August Chinese PMI number will come through. And for July, it was just barely above 50 as well, just 50.2. So it's touch and go on that side. So why we're paying so much attention to the PMI really is there is order flow. During this time of the year, we should be seeing them coming through. Factories should be busy, as I say, making those year-end goodies to be stocked up on the shelf. We will see whether this is merely being postponed, because typically August and September are the two busiest months. It might be just postponed to maybe September or October, leaving a little bit late because we are not quite sure what the external environment is, which is why the next few days, this week, next week, is quite important for everyone in terms of the investment community itself, because obviously you've got the Greek out there asking for, excuse me, can I be excused, or can you extend my trial period to be a good boy? Every government, they try this every now and then. So this is where you've got all these issues of Greek coming back and be in the focus again. And against the backdrop, we have all these PMI numbers coming out, month-end numbers as well. So quite critical. Key things to watch out for still remains those PMI numbers that will be coming out. Next one is September the 1st from China itself. So if you have access to your mail, 9 o'clock or so 10 o'clock a.m. Huh? So look for that number. But before then, you got all the news coming out from Europe about whether the inspection team that are being sent there to Greece uncover any breaches. For sure got plenty one. But whether they'll be forgiven, extended, etc. are all issues, because essentially the politicians want Greece to stay inside. But we know, and I think almost every investment house out there or private sector analysts are basically giving Greece anything from 6 months to 18 months of an exit from the Euro community itself. So we'll see how. At least on the plus side is that while the manufacturing side has been a little bit more weaker, the services PMI perhaps reflecting a greater degree of sort of a consumption of people still for the services side. It is still holding up above 50, but barely just as well. So that's something we have to watch out for. Less of an important, although it just completes the picture at this point as well. On the US side, well, growth has slowed. The good thing at least there is, this is the housing market, housing starts and housing permit all the way from 1960. As you can see, then you never had that kind of a severe correction on the US housing before. So if there's one investment decision and you're brave enough, you might want to wander across to Boston there and check out a few properties over there as well. US, and if you have, if you're going to live a long life, the Sing dollar is for sure going to appreciate once all you have two things. Cheaper US housing and stronger Sing dollar boleh on that side. For your great-great-grandchildren, I think in terms of those kind of time horizon. Because, look at this. When was the last time you had that kind of but again, it is slowly on the mend, but you still have a long way in terms of the peak, etc. As well. But at least from the US side, the recovery is, at least beginning to take shape, although it's coming off from a fairly soft stance at this point itself, because it boils down to job creation. Again, for those who have, some of you may have seen this chart before. For those who are new, I'll say the key things about watching the US. Yes, one side is the housing sector. Housing obviously is also dependent on confidence as well. And confidence is again linked back to what we talked about earlier, job creation. Where got confidence? At the end of the day, it simply boils down to that. And the US, same thing, no different than the rest of us. And job creation, to me, the simplest way of looking at it is if businesses are still not quite sure about whether things are picking up, slowing down, or just blur, but you see some orders coming through, what do you tend to do? You hire temp worker first, just in case things doesn't turn out. And which is why I look at the temp worker trend, the yellow one that I have highlighted, temporary workers. So as you can see, just from looking at that, the last few months, pluser, but although not quite as strong as plus as before. I want to take you to this one here. This is a summary of the temporary worker, the gray bar. That is the July figures. And as you can see itself, even if you times 3, just forgive the third quarter itself, it's likely to be lower than the previous 3 quarters itself. So we know that there are jobs being created, but it's not just as strong as what they would like to see, which is why Bernanke is a bit chot as well, because we have seen 3 good quarters of good hiring, at least on small businesses, etc. But it looks like it's wavering a little bit as well, and that ties very much to the other indicators that we monitor. You may not spend that much time because it's more technical. Private PCE, private consumption expenditure, the red line. As you can see, the red line and the gray bar, they correlate much better. You see, every time you dip, you pull down as well. The gray bar goes up, the lines also go up. Private consumption expenditure is 2/3 of the US economy. They drive the US economy. So if hiring slows down, they also spend less. If hirings pick up, they spend more. It's as simple as that. It's a lesser of a correlation with GDP itself, because GDP have other variables like whether government is adding to the economy or subtracting. At the moment, they're subtracting because they're also bolui, so they're spending less by cutting their workforce. And also one other things like inventory, whether people are adding to the GDP by producing more or consuming more and therefore reducing on inventory. Adding more to inventory adds to GDP. When you subtract by consuming from inventory rather than producing, it also subtracts as well. So the relationship between hiring and GDP is less obvious, as you can see from that between PCE private consumption itself. So for the US, again, reminder, we watch out for the employment data at one level. Second level is the hiring, temporary hiring itself. And the US numbers comes out again fairly soon. It's always the first Friday, normally, if it's not the holiday month or holiday week. First Friday of the new month itself. So we do have lots of numbers coming up, which is why, my colleague on the trading desk these few days, bobang hopa, because everybody cannot whack already. So quiet inside there, even the pin, before it drop, people will catch up already. So, but it's also a good environment for you as investors to do homework as well, because there are companies who will still do okay in this environment. So it's a good time for you to chase all the broker report, compare, do your own homework as well. Best time, because you cannot pressure to do anything, except maybe your broker who was patbang bosu zuo. But you take your time to do your homework, etc. As well, and watching all these numbers. So US, we know this is what we are watching for. Then Europe, except again, we do have a critical period coming up. This is the bottom chart is basically the debt profile. Debt payment is kind of along drawing up the table over there. Say, Asong, you owe me this month, October, you owe me the so I better go and make sure I got that money around. So here is the October month. As you can see, the bar, Italy a lot, Spain a lot. This is in billion euro, so it's quite a big sum, which is why they are scrambling around to say, okay, we need to draw the line at Greece, because if the problem at Greece continues to blow up, the yield, how much it costs to lend to Italy and Spain will be even more enormous as well. So they're doing everything that they want to make sure that the cost of borrowing between now and when they're due, is more manageable. Once you pass these lumps here, I think going into 2013, a little bit more manageable in terms of the debt payment schedule itself. So, which is why they're doing their bestest in terms of, this is just another way of looking at it in terms of how much, again, the along table, or hey, this month, I charge you this month interest rate, this kind of table. So as you can see, Portugal side a little bit better in terms of spread. Basically, is how much it costs, the difference between lending to Portugal or Spain or Italy and to the Germans itself. So the lower, the smaller the number, that is the cheaper it is to lend, which is why to Portugal it has come off because they're a bit more quiet in terms of keeping their house in orders itself. So therefore, lending or borrowing costs of Portugal has come down a lot more, whereas for Spain and Italy, although they have come off, they are still problematic at this juncture itself. So again, this is what we watch out for. This one you mean chart, because every day, if it goes up, newspaper will show a report on, and you will see it on your screen itself. So this is why we're watching up for them, and which is why, if you look relative to this one, why it is important that it matters at this point. What can they do? Actually, it's all really about politicians arguing and cutting and dealing. Not much what we can do over here as well. So while we're keeping an eye on what those politicians can or cannot do, and kicking that cans down the road, as I told some of you, it's only great or good at this point that that can is made in Germany, so quite tahan one, so can kick a few more rounds. If it is made here in Asia, one probably 炸的 big 炸了. So anyway, okay. But bottom line here is, because of the uncertainty in Europe, and we have no clear direction how it will end, it's just like you sneeze. I sneeze in this room. Who catches my flu? I don't know. Same as in Europe, it's that kind of environment at this juncture itself. In the US, at least you can see that there is some ground for optimism, although again in the US, they are going to roll back in spending and taxes, etc. as well, which may lead to a pressure, downward pressure on economic activities in the US itself. We don't know. I think that will still be something that we will be watching out for. But what it means in terms of all these numbers here is, as we can see between Europe and the US, is on both sides, the numbers on the employment side, spending side are all slightly firmer on the US side than the European side itself. Okay, then we come to our favorite, China, in terms of what can they do. I suppose the Chinese, they've got millions of people, literally I suspect, looking at all this going on in both the US and the European side, and essentially trying to stay ahead of potential problem itself. So I think at this point in time, while we're seeing slowdown in the China side, it's more manageable. This is the kind of numbers that some of always been reminded, like electricity production and consumption. It has slowed down, and production has also eased off. But again, for Chinese electricity consumption that we monitor and production as well, a lot of it, 2/3 basically is industrial use, of which a big chunk of that is used, say, by the heavy industries itself. So if the government is actively consolidating the heavy industry, the coal industry itself, you certainly will find that consumption, heavy usage of electricity by those heavy guys will come off at this point. But nonetheless, the trend is fairly similar in that we are seeing some moderation or flattening. This is iron ore imports up to July. This is crude oil imports. As you can see, it's not chong up at the same level, but it's more of a flattening side, which is why the iron ore, all these big resource companies are a bit more panicky at this point, because the Chinese consumption, which they assume to be straight line up, they have flattened it somewhat as well. But at least it's flattened rather than coming off at this point itself. So what they do see is that in China itself, while they are wary that global environment has slowed down, order flows, as we've seen from the PMI numbers, have slowed down, they're also a bit worried about trying to overstimulate the economy, because one of the sectors that have come back alive again is the property sector because of the interest rate cut and an assumption that there will be more stimulus along the way as well for the economy and hence the property cycle itself, which is a bit of a concern. And obviously, the news coming out from China is that with the central government telling the regional government or the local government, hey, okay, we are giving you some flexibility to spend on local projects. There have been a lot of announcements, which is why the last line itself, since July, a lot of the government from Chongqing to Hainan has announced total spending plan of already 7 trillion. Put that into context. In 2008, after the Lehman crash, the Zhenghu rolled out a plan of 4 trillion, and the economy went ballistic after that. So just imagine if they were to do 7 trillion. So it just happily every local government drawing up it's just like Christmas list. What do you like to do? So, wow, I see everything down and say, okay, we got this. So some people tell you, I was saying, so 7 trillion already. It's highly improbable, mainly because local government borrowing. They can only collect money from property tax, and that's a little bit more quieter, or revenue from the government, from the central government, because local taxes goes to the central government itself. So the only way they can raise funds is by issue bonds or property tax. But there will be a little bit more control over them. But certainly there is some step up in spending on the Chinese side, focusing on, say, clean energy, renewable energy, those kind of things. They have already announced plan on that side itself. The plus side, inflation is still contained, but obviously there's a risk, because we all read and quite in TV there how severe the drought in the US is, in India is, because of the weather disruption, etc. But if you look at the Chinese side, I think they're also aware of the risk of El Nino coming back. This is Chinese import of maize and wheat. As you can see, compared to previous years, they haven't imported as much, or basically not in the same cycle. So I suspect this time around again, they look at the weather forecaster and say, follow them. If there are risks of weather coming back, let's import a little bit more, have a bit more inventory itself. So I think this time around for us in Asia, it may not be as severe, but obviously it depends on how bad the weather going forward will be like. This is the so-called the El Nino La Nina indicator, this Southern Oscillation Index, or the SOI. When it is strongly negative, we got dry weather here. This is basically the difference between the temperature from onshore Western Australia and the sea itself. So it's strongly negative, we have dry weather here. So far, I think it doesn't look like here certainly as bad a reading as in 2010, 2009, and which is why I think we are a little bit more sanguine, perhaps too sanguine, about the impact of drought supply disruption. But the other thing which has helped, apart from the fact there's inventory, is that the production cycle here still remains okay. Palm oil, this is rice. So as you can see, rice international prices holding steady because there's still adequate supply. And over on this side, palm oil inventory is still okay as well. So it doesn't look like at this point, certainly for this year, that we have too severe a risk of perhaps food inflation. But obviously, if the weather condition were to worsen, so again, if there's one thing you want to monitor for, every fortnightly, log into the Aussie website, bombgov.au. Not for making bomb, there's a the Weather Boys forecast website itself. Very useful in terms of giving a little bit of a heads up of what's happening on the weather front and therefore food supply disruption, etc. as well. Well, this is more of a reminder of why, here in China itself, they're a bit more worried that despite signs of external sector weakening a lot more than we all expected, domestically, they're a bit chot-chot as well. This is the property market summary of the price trend of key 70 cities in China. The green bars basically summarize how many cities have shown sequential month-on-month price increase. And in July, last month, we are seeing that it's the first time in more than a year that more cities have shown sequential price increase than price decline or no change itself, which is why the Chinese government is a little bit concerned that if they were to loosen or pump more money into the system itself, the property market could revive again, and in the event that the global economy continued to struggle, many could become non-performing loans itself. But it certainly looks like, whether in terms of floor area under construction, it has bottomed out over there. So their worry is, if they are too aggressive in loosening policies, the asset market, which they took great pain to cool down, could reignite very quickly itself. But I think they may have to do something in terms of policy front if the September 1st PMI numbers were to fall below 50. Maybe they will tighten more on property side just to ensure that the discipline to maintain sort of price stable or price stability remains while they loosen to promote growth in the economy itself. So which is why they haven't been as aggressive in promoting so-called lending or cutting their interest rate. But I think they may have to do so once the growth itself starts to slow down more meaningfully. Okay. This is, again, the inflation picture for the region, which remains okay. So I suppose for us, coming back here, so far we've taken about a couple of things that may help you in your investment side, apart from doing your own homework on the equity side in various brokers. The indicators on PMI that comes out towards the end of every month and the beginning of the month. The employment numbers that comes out every first Friday from the US itself. Watch the yield or the interest rates on the European side, and that is easily monitored as well. And here in Asia, we look at, I suppose, China as an anchor economy itself. So far, there remains, I think, on a soft landing scenario. But what we do see is that the growth momentum has slowed down, even though it is still, I think, quite a respectable growth that we are seeing around the region itself. Now, in the event that what happened in Europe, let's say Greece create a little bit of uncertainty, can we tahan the so-called shock? I think we can. I mean, here is just a few slides of the fundamentals that we have. This is the forex reserve of the economy here, i.e. how much we got as in a piggy bank in case things hit the fan, so to say. So far still okay in terms of the reserve, still quite strong, as you can see through all itself. In terms of balance of payment, basically again is how much savings the country as a whole has to give themselves a little bit of a buffer. If you look at it, so far the overall ASEAN itself still healthy surplus in terms of as percentage of the GDP, while the G7 side continue to suffer from outflows to some extent. GDP growth, I think, still quite decent, generally speaking. This is the health of the government, and I think the weakest one over there remains the Malaysian side, but that's because they continue to subsidize heavily, and more so at this moment when they have election around the corner itself. So, in terms of all these, what does that mean for the outlook over the medium term? I think it's still quite okay for now, but obviously much will depend on how things pan out over in the US side, and certainly at this point, and the European side. So what we do basically now is just keep our fingers crossed, watch what's happening. In terms of the equity side, you find that stock still remains, Singapore side still, I think, remains reasonable. It still remains those key sectors that one look at, which is why we're all pak bang at this one, because every broker says stay in the oil and gas sector, stay still in the REIT side, although the yield compression is making it less attractive at this point itself. There are companies which are benefiting from the boom around. If you look around, there are lots of crane going up, so I think Tak Hong will still be enjoying good rental, say, from that side. They're still digging underneath holes on the ground there, so Yongnam still enjoys that as well, although the question now is cost of foreign workers is the key one. Managing cost is an issue for all of them and all of us as well. So while there are growth out there, we also need to be mindful of the cost side. So that's the kind of take that I want to leave you with, in that our kind of destiny is not in our hand at this juncture, it's outside. But what we can do at this moment is just to look at what are indicators that perhaps will help us make our investment decision a little bit better. I will stop here, and then other speakers, and I think we have panel discussion subsequently as well to answer some of the questions. But otherwise, thank you very much for your attention, and have a good afternoon ahead. Thank you.